I'm Matt Bishar with REIT.com here in Boca Raton, Florida for REITWise 2014. I'm joined by John Rowe, Head of Advisory for ISS Corporate Services. John, thanks so much for joining me today.
Thanks, it's a pleasure.
Here at this event, you were on a panel focused on SayonPay. What steps do you recommend that a REIT takes to win its SayonPay vote?
That's a great question. A couple of years ago, the conventional wisdom was all you had to do was provide shareholder return and the SayonPay votes will come. But I think over time we've seen that actually change quite a bit. What we're seeing now is portfolio managers and institutional investors praise a REIT for their strong shareholder performance, but on the flip side, they get an against vote on their SayonPay proposal. So now we're into a second era of SayonPay vote and how companies are going about earning them. And really now it's a two-step process. The first step is to generate a compelling pay program right from the start. That's the easiest way to earn the SayonPay vote. And what does compelling mean? Well, there's usually two components to that to start with. One, a large percentage or a large portion of that pay package should be performance contingent. It shouldn't be granted automatically just because the CEO was in seat. And second, the pay program should be set up to create long-term alignment between the executive and the shareholders. And that's really the first step. And we see companies making mistakes in this area time and time again over things like guaranteed multi-year bonuses or excessive perquisites or benchmarking practices that are simply out of line with market norms. Once those decisions are made, though, there's a second piece to winning the SayonPay vote, which is really about what do you do after the decisions are made. And that goes into how the CDNAs are drafted. And when you're drafting the CDNAs, the important thing to consider there is focus on the why. Most CDNAs are drafted in a way that talk about the hows and the whats, the data, the facts, the figures, the performance criteria or the absolute numbers in the bonuses and in the stock grants and in the option grants. But the whys are much more important. The whys are about why did the compensation committee feel like they should divide the compensation up this way? Why did they target a certain peer group to benchmark their pay against? Why are they delivering certain governance restrictions around the equity payments the way that they are? So addressing those issues as part of the CDNA are really, really important to winning the SayonPay vote today.
And how does new ISS guidance change the state of play?
ISS this year, from what we're seeing, has made an important shift in how it's looking at some REITs. Before, internally managed REITs and externally managed REITs were all lumped together when it came to SayonPay vote evaluations. And that really put internally managed REITs in a disadvantage. These externally managed REITs often didn't have any highly paid executives at all. And when you're using those as part of the benchmarking group, it makes it more difficult for these internally managed REITs to look appropriate. So ISS this year is actually, from what we're seeing, actually excluded these externally managed REITs from the mainstream group of REITs when they're doing their pay for performance evaluations. And I think that's generating a lot of tailwind for internally managed REITs to help improve where they're standing in terms of quantitative testing that ISS does and ultimately resulting in a better SayonPay vote recommendation.
And lastly, what do you view as the most critical governance-related issue for the publicly traded REIT industry?
The most impactful problem really is a perception problem more than anything else today. When we look at actual governance practices in the REIT industry, there's a lot of areas where REITs are actually ahead of their non-REIT colleagues. Areas like board declassification. 42% of non-REITs have classified boards. Only 21% of REITs have classified boards. Half the number. And that's an important governance quality to a lot of investors, having that declassified board to have a little bit more control over the direction of the company. And that trend translates into a number of other areas also, areas such as disclosing the board's decision-making policies. Many more REITs do that than non-REITs. So, managing that perception issue of governance practices that may have been in play 10 or 15 years ago, but aren't there anymore today, seems to be the biggest problem that REITs have from a governance perspective.
John, thank you so much for your insights.
My pleasure.
For more on this and other REIT news and analysis, be sure to visit REIT.com.